X Limited wants to replace its old machine with a new automatic machine. The models A and B are available at the same cost of rupees 5 lakh each. Salvage value of the old machine is rupees 1 lakh. The utilities of the existing machine can be used if the company purchases A. Additional cost of utilities to be purchased in that case are rupees 1 lakh. If the company purchases B, then all the existing utilities will have to be replaced with the new utilities costing rupees 2 lakh. The salvage value of the old utilities will be 20,000. The earnings after taxation are expected to be, we have information about 5 years cash flows of project A as well as mission A and mission B. We also have information about the PV factors for 5 years at 15%, and salvage value at the end of year 5 is 50,000 for mission A and 60,000 for mission B. The targeted return on capital is 15%. You are required to compute for the two missions separately the NPV, discounted payback and desirability factor, and advise which of the missions should be selected. So in this problem we should have clear understanding about what is the initial cash outflow, and annual cash inflows are easy because we have data in a table form, so we just have to product them, but finding what is the initial cash outflow is more important. Let's get started with that. Expenditure at year 0. What is the actual expenditure at year 0? We should have a clarity on that, because the company has to purchase either mission A or B. So what is the cost of mission? For both A and B, the cost of mission is 5 lakhs. But cost of utilities, there is a difference. If the company is purchasing mission A, the cost of utility is only 1 lakh because they can make use of the existing utilities as well. So cost of utilities for mission A will be 1 lakh. Whereas if the company goes for mission B, then they cannot make use of the existing utilities, and the cost of utilities for mission B is high, it is 2 lakhs. Okay, and when they are purchasing the new mission, they have to sell their existing missions, and that gives the salvage value of 1 lakh. So that's going to be common for both. It is 1 lakh. But when they purchase mission B, they cannot use the existing utilities, so they have to sell off the existing utilities. The salvage value will be 20,000. Salvage of old utilities, which is not applicable for mission A but applicable for mission B, which is 20,000. So this is the initial cost. So in mission A, it's going to be an outflow of 6 lakh and inflow of 1 lakh. So net of it is 5 lakh. For us mission B, it's an outflow of 7 lakh and inflow of 1 lakh 20,000. So it is net of 5 lakh 80,000. So we have found the initial cash flow. Now we'll move on to the discounted value of cash inflows. So we'll give the year information. It is 0 to 5. 0 stands for the initial outflow, and in 5 itself we'll have 2-5 because the cash flow, the regular cash flow at the year 5 and the terminal cash flow of disposal of machineries. Then we'll also list out the NPV factors, which we have picked up directly from the question. Then we'll move on to mission A. We have cash inflows and outflows of mission A. At point 0, it will have an outflow of 5 lakh. That's what we have computed now. And over a period of 5 years, there are some cash flows information is available in the question. I'm just fitting them. So now what we can find is discounted cash flows. That is, these cash flows can be multiplied with this NPV factor. So discounted value of cash inflows is equal to NPV factor multiplied by cash flows, and that's going to give value like this. That is, we have multiplied 1 with -5, so it's -5, 0.87 with 1, so it's 0.87, 0.76 with 1.5, so it's 1.14, and goes on. So this is up to year 5. And in year 5 there will be a salvage because there is going to be disposal of the existing mission. And in year 5 the NPV factor, we know it is 0.5, and cash inflow at that point is how much? It is 50,000, so it is 0.5. So 0.5 multiplied by 0.5, we get the discounted cash flow as 0.25. So this makes the total as 5.44. So here you have 5.44 as total of inflows, and here you have an outflow of 5 lakh. So 5.44 minus 5 lakh gives a positive NPV of 0.44. Please note this 5.44 is only a total of these items starting from 0.87 to 0.25. So NPV of project A is 0.44. Similarly, let's go for mission B or project B, where the cash flows are starting with 5.8 we have found in our working note 1, and the cash flows whatever available in the question we have fitted. Then we can find the discounted cash flows, which is nothing but these cash flows multiplied by the discounting factors. So by multiplying year after year we get these values, and for mission B also there will be a salvage value at the end of its useful life, that is after 5 years, and that salvage value is slightly higher than mission A. Mission A had 50,000 whereas mission B will have 60,000. 60,000 multiplied by 0.5 is going to give you 0.3. So now we'll take total of all these cash flows starting from 1.74 to 0.3, and it is 6, and initial outflow is 5.8. So NPV is 0.20. So both the projects has positive NPV. So both the projects are apparently acceptable. So we have answered the first point in question. Now we'll move on to the second requirement, finding the discounted payback period. So how we are going to find? First let's list out the years. Year starts from 0 to 5, and let's work on mission A. Discounted cash flows we have already calculated in NPV table. We are just going to lift and fit those values here. I mean, in 0.0 it will be 5, and in first year it is 0.87 what we have calculated in previous working. So cumulative cash flow is also going to be 0.87. Second year it is 1.14. So here cumulative cash flow will be 0.87 plus 1.14, which is 2.01. Third year it is 1.19, so it is 2.01 plus 1.19, so it is 3.20. Year 4 1.14, so it will be 4.34. Year 5 1.10. What is this 1.10? Which is basically the cash flow of 0.85 plus the present value of salvage of mission, which is 0.25, and here you will have the value as 5.44. So why we had come till 5.44? Why this cumulative cash flows were carried till 5.44? Because we are concerned about discounted payback period. That is the period at which the cumulative cash flows touches the initial investment. Initial investment was 5 lakh, and here it is 5.44. That is, it has crossed 5 lakh. So the discounted payback period is between the 4 and 5 years. We are concerned about exact 5 lakh. So we have to find at what period, say it may be somewhere in the beginning of 4 or beginning of 5th year, or it may be between 4 and 5 years. We have to see that. Before that, let's complete the calculation for mission B also. Mission B had certain discounted cash flows, and in the same way we can find cumulative cash flows for mission B. In first year it will be 1.74, and second year it would be 1.74 plus 1.6, which is 3.34, then 3.34 plus 1.19, which is 4.53. In the fourth year it is 5.5. In the fifth year it is 6. In mission B we are concerned about the recovery of investment of 5.8 lakhs. Is it not? Here it is 5.8 lakhs. So at what point this 5.8 lakhs is recovered? So if you compare, in fourth year 5.5 lakhs have been recovered. In fifth year it has crossed, or it has touched 6 lakh. It has crossed 5.8. So for mission B also the recovery or payback period is between 4 and 5 years. So now let's go and see how to find, that is, discounted payback period for A and B. We understand for A, in 4 years major recovery has been done, and between 4 and 5 only there is a balance recovery. That is, for mission A, in 4 years almost they have recovered up to 4.34. We are concerned about only the difference between 4.34 and 5, that is only that 0.66. So In 4 years, 4.34 has been recovered. In 5th year, we are concerned only about this 0.66, whereas total cash flow in year 5 is 1.1. So 1.1 is for 1 full year, what is for 0.66, and that would give us 4.6 years. So in 4.6 years, entire 5 lakh has been recovered using discounted payback period for mission A, whereas mission B, in 4 years 5.5 lakhs has been recovered, and we are concerned only about the balance of 30 lakhs, and in 1 full year we are concerned only about the balance of 30,000. In 1 full year they have recovered 50,000. So for mission B it is 4 years plus the gap of 30,000 which has to be recovered, whereas in 1 full year they have recovered 50,000. So 0.3 divided by 5, and that also gives us 4.6 years. So the discounted payback period is common for both mission A and B. Next, let's move on to the third part, which is finding the probability index or desirability factor. Probability index is simple. Here we take the sum of present value of net cash inflow and will divide it by initial cash outflow. For project A or mission A, it is 5,44,000. So 5.44 lakhs divided by 5, and here it is 1.08. Whereas for project B it is 6 lakhs but divided by 5.8, and it is 1.034. So comparatively, project A stands in a better way, though project B gives a cash inflow of 6 lakh. Looking at profitability index, project A stands in a better way. Now we'll list all the 3 methods and we'll see which mission should be selected. So we had 2 missions A and B. In first method, that is the NPV, project A had an NPV of 0.44, whereas project B had an NPV of 0.2 lakhs, that is 44,000 and 20,000. So selection should be for the missionary which has highest NPV. So here the selection is A. Then when we moved on to discounted payback period, project A had 4.6 years of payback and project B also had same. So DPB method was neutral. Next, let's move on to profitability index. Project A had a profitability index of 1.08, whereas project B had a profitability index of 1.034. So only those projects which will have highest profitability index will have to be selected. So here it is project A. So out of 3 methods where DPB is neutral, we cannot take comparison. In other 2 methods, NPV and profitability index, the project A stands in a better position. So project A, that is mission A, should be selected.